It is a trend that is growing with legitimacy by the day, and I think to underestimate it is a mistake. I think that that's kind of what they're counting on. I guess we'll see how it all plays out. This is not a common currency. This is a common settlement currency, with gold replacing not the dollar, but really what stands behind the dollar, the trust that we've lost.
I think you're absolutely right about that, Andy. And the only thing that's missing is a fixed exchange rate between gold and yuan. And I think that will come. It'll come in time, not very much time. And I guess that from China's point of view, that's really where they see themselves going. But they can't introduce it, if you like, without the dollar actually destroying itself, for the very simple reason that China does not want to be blamed for the end of the fiat currency system.
A quiet revolution is unfolding in the global financial system, and most people haven't even noticed. According to Andy Schectman, what's being built isn't just an alternative payment system, it's an entirely new monetary ecosystem, one backed not by promises, but by physical gold. He explains that China and its trade partners are constructing a network of multinational gold vaults across the Belt and Road Corridor, designed to enable direct settlement in metal rather than dollars. The first vault in Hong Kong is already operational and connected to the Shanghai Metals Exchange, allowing holders of digital yuan to instantly convert their currency into gold without touching the U.S. banking system. A second vault is rising in Saudi Arabia, a symbolic and strategic move by an energy superpower that once priced everything exclusively in dollars. This shift is being mirrored in Western financial circles, where institutions that once dismissed precious metals are now quietly reshaping their portfolios. The old 60-40 stock and bond allocation is being replaced with strategies that include 20 to 25% in gold and silver, reflecting a growing loss of faith in government debt. Even central banks have been aggressively selling treasuries and stockpiling bullion. The market has already spoken over the past year. Gold has surged nearly 50%, dramatically outperforming U.S. bonds. Alastair Macleod agrees with Andy's assessment and adds that the only missing element in this emerging system is a fixed exchange rate between gold and the yuan, and he believes that's coming sooner rather than later. From China's perspective, that's clearly the endgame. However, they can't formally introduce such a structure until the US dollar weakens on its own, because China does not want to be blamed for triggering the collapse of the global fiat system. If you found this video helpful, don't forget to like, share, and subscribe to stay updated. We'll continue delivering sharp insights and expert perspectives on the forces driving gold, silver, and the broader financial landscape. Thanks for watching.
I think I heard the majority of the question. There was an awful lot of feedback in there. But in any case, if you're speaking about change in the interest rate environment, I don't know, I find it very interesting that we see the chief investment officer for Morgan Stanley shift from a 60-40 allocation to a 60-20-20, 60% stock, 20% bond, 20% precious metals. Michael Hartnett, the chief investment officer for one of the investment, I think he's chief, for Bank of America, just came out with a 25-25-25-25% strategy. Again, you're seeing big money advisors, money managers, or investment officers reallocate their clients' portfolios away from a 40% allocation to U.S. Treasuries. They are pivoting into what would have been unimaginable. As Rick has often said, and you know, I borrowed that statement from him for so long, 0.5% from Joe and Jane Sixpack to the Harvard Endowment Fund, and I caught the last part before I jumped on here where the Harvard Endowment Fund actually did buy some gold and silver. But we are beginning to see, I think, the money managers or the investment officers from these large institutions pivot the way that the central banks seem to have been doing now for at least a year or two, where they have been shedding U.S. Treasuries in favor of gold, which not only has outperformed the U.S. Treasury market. In fact, it's doubled the performance of the 10-year Treasury over the last 25 years. But look at last year, where gold was up north of 40% and the U.S. Treasury 4.5%, or this year, where you have the U.S. Treasury three-quarters of the way through the year, call it up 3%. Yet the dollar's down 11 and gold is up nearly 50. So we are witnessing a pivot away from traditional forms of investment, traditional ideology, into something that we have been talking about that was fringe. And you never heard money managers talk about anything greater than a 5% allocation to precious metals. Now, we always knew that that was underweighted, certainly, but to see the CIO from some of the biggest commercial banks on the planet start to do this tells you that we are moving towards some form of a new understanding, appreciation, or integration of gold and silver into people's portfolios. And quite frankly, if they would have been listening to guys like Alistair or Rick a long time ago, these moves would have been made years ago when there was still a tremendous amount of upside to be made. Now, not to say there isn't now, but how much of the move has been missed, I guess only time will tell. Actually, I don't think that it's been too much in comparison to where I think it is going. But I think the most important thing to take away from this is that you're seeing some of the biggest and influential institutions here in the United States rethink their investment ideology. It's an interesting time, and I hope the general public catches on before it's too late, because I can tell you on the retail side of things, we've seen very sophisticated big money jump in with both feet over the last month or so. Business has been extraordinary. It hasn't been what it was like in 2021, January, February, silver squeeze, where we were getting 500 orders a day. Now we're getting more like maybe 100 or 150, but the size is much greater. The understanding is much greater. The mainstream, they haven't really woken up yet, but there is a subset of people probably listening to Rick and Alistair and you, Dunnigan, who are waking up. And hopefully it's not too late for the rest of the public. Certainly, I think this is a change that is long overdue and one that I welcome very much. So, well, I think the biggest indictment against the system is, well, there are a couple. Number one would be the cross-border payment system, the renminbi cross-border payment system that was the M-Bridge. And this system, which is operational, has already been connected to 11 countries in Southeast Asia, which in and of themselves have twice the population of the United States, about 800 million people. And they also have taken over as China's largest trading partner by far. They represent almost 40% of global GDP. They've also connected several Middle Eastern countries, 5 or 6 of them, into this system. And I think when you take a look at the moves that they are making, it is the development of multi-jurisdictional vaults throughout what ultimately, I believe, will be the Belt Road Initiative. The first vault is completed in Hong Kong. The Shanghai Metals Exchange is expanding their reach. The first one is done in Hong Kong. And what it basically means now is that digital yuan is immediately convertible into gold in the Shanghai Exchange in Hong Kong, if you'd like, for delivery without having to convert first back to US dollars. Now, the second exchange, ironically, is being built in Saudi Arabia. The key is that they will be able to settle imbalances in gold, and ultimately, through a series of multi-jurisdictional vaults that started in Hong Kong, is now being built in Saudi Arabia, and then through the rest of the Belt Road, so that they can settle imbalances in gold or completely settle in gold. I think it is a trend that is growing with legitimacy by the day, and I think to underestimate it is a mistake. I think that that's kind of what they're counting on. I guess we'll see how it all plays out. This is not a common currency. This is a common settlement currency, with gold replacing not the dollar, but really what stands behind the dollar, the trust that we've lost. Anyways, that's what I think about the BRICS, and I'm happy to keep going if you want.
I think you're absolutely right about that, Andy. The only thing that's missing is a fixed exchange rate between gold and yuan. And I think that will come. It'll come in time, not very much time. And I guess that from China's point of view, that's really where they see themselves going. But they can't introduce it, if you like, without the dollar actually destroying itself, for the very simple reason that China does not want to be blamed for the end of the fiat currency system. But this is looking like Bretton Woods version 2, essentially. Gold would not be exchangeable for ordinary citizens, but when it comes to trade imbalances, That will be the medium.
The growing divide between Andy Schectman and Alastair Macleod illustrates a broader debate within the sound money camp, not over whether the dollar is dying, but over what comes next. Schectman argues that the rise of BRICS pay marks the beginning of a parallel settlement network that bypasses the US dollar entirely. In his view, clinging to fiat currency has become financial negligence. The prudent move isn't to wait for collapse but to preempt it by rotating into assets historically resilient to monetary debasement: gold, silver, mining equities, and even select cryptocurrencies as speculative accelerants. Macleod, however, trims the options down to their core. Yes, fiat is failing, but some failures are slower than others, and for now, the dollar remains the strongest of the weak. His prescription is brutally simple: abandon all forms of credit, including crypto, and migrate into tangible monetary assets. Gold is the anchor, silver the high beta play, and mining stocks the potential leverage for those willing to stomach volatility. Speculation may have its place, he concedes, but settlement belongs to metal, not code. Let's get back to the interview.
And I guess I would add one other piece, is that when you add into it the BRICS pay layer, which is the B2B side, where anyone who possesses this technology will be able to use it to conduct business. And the fact that it's being rolled out to 75% of human population, the fact that the only institutions, the only countries that will not be able to use it are those within the European Union, the UK, or the United States. All of this settlement outside the dollar, whether it be on central bank side or on the B2B side, on the retail side, is chipping away little by little at the dollar hegemony. And then when you add into it the ability to purchase gold instead of U.S. treasuries, as has been the status quo forever, this chips away at the reserve status. And why would anyone want to own our treasuries with our fiscal irresponsibility, $2 trillion deficits every single year, and the weaponization of the treasury market, the ability to sanction. And President Trump, God bless him for doing what he's trying to do, but you know, when you say to the BRICS countries, if you do this, you unite, we're going to add 150% tariff. That is not a tariff, that is a sanction. This is what is pushing all of these countries together. And I guess, to me, the stroke of genius in all of this is not just making it proprietary to the BRICS countries, but opening it up through a series of treaties, if you will, through all of these countries who are in some way or fashion tied to the BRICS countries.
Well, if I can just butt in here, I very much take the point that the dollar is the king rat of currencies. It is the top fiat currency. I mean, when you look at what's going on in Europe, France, Britain, Germany, etc., I mean, there's absolutely no doubt that the euro, sterling, also the Japanese yen are fundamentally weaker than the dollar. And they don't have that cachet, if you like, of being the reserve currency, any of them. And I mean, thinking about the geopolitical situation, I mean, there's no doubt that Russia is winning the war against Ukraine. That will be won on the battlefield. We just have to think what that's going to do with the euro. That is going to be, I think, a catastrophe for the euro. Principally because the European politicians, they haven't a clue what they're doing. They don't understand. They just don't understand what's going on to the east of them. And not only that, but there is so much money being invested in defense, and also, lines, previous bank lines and all the rest of it into Eastern Europe. This I think is going to be, that's going to be the moment when the euro really starts falling, really declining. It's not so much the inflation story, it's the loss of confidence story. That's what they've got to watch out for. And as the sterling, the only reason it's where it is because its bonds are yielding higher than any of the other major currencies. But we've got a real disaster on our hands here. We really have. And that is going to drive sterling down against the dollar. So, I mean, your point, I think, is right. But, these are all forms of credit. How do you know it's credit? Well, because there's an obligation on the other side of some balance sheet or other. In this case, we're talking about central banks as issuers, to actually pay. Now we know it's a it's a balance sheet entry, but it is credit. And this is why the only way to, if you like, hedge yourself against this catastrophe, it's coming catastrophe, and it's not just America, it's Europe, Japan, etc., with all the central banks technically bust. The only thing to do is to get the hell out of credit and get into gold. And at the moment, silver seems to be probably somewhat better. And you could probably also get a bit of leverage if you know what you're doing, and that's the key in the mining sector. Because there's an old story in London about Australian mines that, how do you define a mine, a hole in the ground, surrounded by liars at its top. So, you got to know what you're doing in that game. But the rewards, I think, could be absolutely tremendous. They really could be.
I don't think you need to know much more than that. That you need to have assets. Assets feed you, liabilities eat you. The dollar is a very big liability right now in terms of retaining and maintaining purchasing power. The dollar's down 11% already this year against a basket of currencies. It's down nearly 50% against gold and silver. So to me, the biggest mistake people can make is to have too much emphasis, if you will, on the U.S. dollar. And I think that is an easy one. At least to me, that's a softball. So it would be to mitigate your exposure to the U.S. dollar best you can and find assets that will do well in this type of environment. Precious metals, equities, even cryptocurrencies. I think that keeping your money and saving in dollars is the absolute worst decision one can make right now.
Alistair, anything to add to that?
Yeah, I would caution cryptocurrencies. I mean, Bitcoin reminds me of the tulipomania, but without even the physical presence of bulbs. That is, it is a symptom of massive speculation. It's really as simple as that. It's got no legal standing whatsoever. And furthermore, it's being used by crooks and shysters. It's got all the wrong people in it. I wouldn't touch it with a barge pole. So, stay out of crypto. It's a waste of time. There is only one legal form of money, final settlement, and that is gold. Possibly silver, but particularly gold.
Global finance is rapidly shifting from trust-based paper promises to proof-based settlement. One side sees innovation in emerging rails that allow businesses and nations to bypass traditional monetary choke points, settling value in harder forms without needing legacy intermediaries. The other insists that only time-tested stores of value deserve to be trusted in moments of systemic fracture. Their prescriptions may differ at the margins, but their warning is identical. Remaining passive in fiat is no longer a neutral position, it is an active bet on continued dysfunction. As monetary credibility erodes, wealth will flow to those holding assets that cannot be debased, seized, or frozen by policy. In the end, real money will expose imitation. What happens when confidence in fiat evaporates faster than the alternatives are ready to replace it? So stay tuned for clear, data-driven insights into the financial system. Don't forget to like and subscribe so you never miss our weekly updates. Thank you for your continued support, and we hope you enjoy the video.